As widely expected, the Fed kept interest rates unchanged, though the central bank did keep its options open to hike again down the road. Joining us right now is Kelsey Berro, a fixed income portfolio manager at JPMorgan Asset Management. Good morning to you. So he said nothing. I don't want to say he said nothing. The question is, what did he say? Underneath what he said, underneath doing nothing, he said what?
So I think there's a couple things that I really took away from what Chair Powell said at the press conference, because like you said, there was no change in the rate. We're still at 5.25 to 5.5. He said they've made no decisions about the future, but I think it's all about the risks. He said the risks now are more balanced than they've been in the past. And why? Because financial conditions have tightened. And that was the one small, tiny change they made to the statement. Mostly, they didn't even really need to have a meeting because they barely changed the statement at all. But they made one small change that they highlighted that tightening in financial conditions as well as that tightening in credit conditions. And that's giving them confidence that if you look forward, we're going to see slower growth in the fourth quarter. Inflation is going to continue to come down. And ultimately, I think the policy setting that they have is tight enough. Just look at home affordability. Right. It's the lowest on record back to 19.
I don't mean to suggest, by the way, that he said nothing. But let me just ask you, let me ask you a different question. Tom Lee was out last night saying that he thinks that they've effectively saying we're no longer data dependent. Do you believe that?
No, I think that they're very data dependent. The payrolls report on Friday is very important to them because what they're trying to understand right now is we've had some strong growth. We've had some better payrolls report. Is this going to derail their objective, which is ultimately price stability above all else?
Future data dependent. They're just not. I think Tom Lee was making a point that nothing, and we made that point earlier, nothing in the recent numbers would indicate that that's mission accomplished for slowing the economy down. But you point out that the tightening of credit conditions, you can expect that to be the result of what we've seen. So I think they're future dated. That's the way they should have always been, is future dated. You can't use coincident indicators to set policy.
Right. So Q3 is in the rearview mirror now, and they're trying to understand what is going to happen in the future. And I think what we're seeing in the leading indicators is that you should be expecting growth to slow down. Right. The consumer is being challenged by higher interest rates. It takes longer for it to happen, particularly in an economy where you have a lot of fixed mortgage rates, but it is happening. And I want to say one key thing, too. It's not just about what's happened, but what is the market, what is the bond market pricing? The market is pricing right now, if you look at the forward curve, a Fed funds policy rate that never goes below 4% in the next 10 years. I think that's a very optimistic, a fairly sanguine view of if the economy can really handle these high rates. And what does that mean for a bond investor? It means yields right now are very juicy. There's a lot of term premium already priced into the bond market.
Did you hear Gunlick yesterday? He has a view that it's not that we're going to raise by 50 points. He thinks they're going to go down by 200 basis points.
He said a recession by this year or last time, a couple months ago.
Right. He thinks. Where do you stand there?
This is all about the risk reward, right? So there's a risk they go another 25 basis points, but there's another risk, the larger risk, that is they're done. And when they start cutting, we know that the Fed, when they start cutting a lot. They start cutting quickly. So the risk reward here, I think, is very attractive. Fixed income, for that reason, fits into a number of different portfolios. If you're looking at it from the equity perspective, right, high yield right now is yielding 9%. If you look at what long-term equity returns, historic and expected, should be, I mean, high yields is providing a very attractive opportunity and for a lower unit of risk. If you look at it from the other side, if you're sitting in cash right now still, which is at 5%, why not lock that in for a few years? And again, that's the story again of that risk reward. You can get a little bit higher in yields,
you
can also come down a lot.
If we're going into a hard landing, you don't want high yield.
Well, of course. I mean, you need to think about these things, but I think fixed income fits into a portfolio in a number of different ways.
You think go longer, 5, 10?
I would say that we would be encouraging investors to step out of cash and lock in those yields because there is reinvestment risk.
10 years?
5 years, 7 years, 10 years. It will depend on the client.
So
but
you're ready.
We are ready for the Fed to be done. We don't think that they're going to be hiking again. And so that means that the next
portends a lock,
move, if
right.
it's not up, is going to be down.